The streaming focus is interesting because actually they warned that in that fiscal first quarter of the next year might taper off a bit. But I don't think I've ever seen, have you ever seen Disney say, for the next 3 years we'll see earnings growth, and this is how we feel about the streaming business in particular?
Yeah, I mean, I think this is a major inflection point for Disney. It's an incredible value for investors at this price, literally trading at half the value of Netflix, but with all these other businesses in sports and in experiences. So, you know, their streaming businesses grew like crazy during the pandemic, but they were spending so much money it made no sense. And now they've gotten this right. And as they move forward with aggressive pricing, actually, and incredibly good content, people are not canceling their Disney and they're not canceling their Netflix, but we've seen a lot of churn in the other streamers. So what we've really seen is what we hoped, which is Disney and Netflix have come out as the winner in streaming.
Caro asked a really interesting question about password sharing. You know, we got that wrong with Netflix. You know, didn't seem to impact Netflix negatively necessarily. Do you just see Disney following the same arc? You know, Johnston kind of leans on this idea that they've not been at it very long in the streaming game, but they have grown quickly.
Right. I mean, they grew much quicker than anybody would have guessed because of the pandemic. And they really just were not good at managing the cost side of the business. And they were making tons of content that they weren't releasing in theaters that was costing a fortune. And now getting the model right, like Moana 2, like I was watching Deadpool last night. Deadpool and Wolverine goes out in the theaters, that makes $1 billion. Then it goes on the streamer. Everybody want to watch the streamer. And that's what we're going to see with Moana 2 coming. And then we have Mustafa, which is Lion King 2 coming in December. And boy, this is going to drive, you know, not only keeping the people from churning on the streamer, but adding new subscribers who really just want to watch the movie, you know, and not have to pay for a la carte, you know.
What's interesting, Ross, is that Hugh in particular tried to articulate this vision that, yes, TV cable is showing weakness, but it basically feeds the beast of streaming and stop looking at it separately. But there's also this element going forward that they've got to do something to change revenue operating profit in the different direction and start showing stabilization or at least growth once again. And that sort of can be said more broadly when you're thinking of Venue back on ice, when you're thinking of Venue Sports, the joint venture they were going to be doing with Fox and Warner Brothers. There are some stop-starts here.
Well, yeah, and see, part of it is ESPN has this limitation because it's still, you know, tethered to cable for another year. And once that is done and you can actually get ESPN as a standalone app with real ESPN content without actually a cable subscription, that will open up opportunities for ESPN. They've just been unable to open. But the cable issue is one that will continue to be one for some time. And you know, some cable companies get it, like Spectrum, where they've pivoted in the business and tried to create value for cable subscribers. But like, mostly young people today don't even know what cable is. So, you know, so feeding the beast of streaming is the appropriate strategy. And young people today will sign up for multiple streamers and pay the money, and it's still cheaper than cable from the old days. But, you know, Netflix and Disney have the opportunity to really engage a global audience that has, you know, potentially as many as 500 million, maybe 1 billion subscribers total in this total market globally that they can grow to.
Let's just look at that valuation. You talked about how basically Disney is half a Netflix. It is when you're looking at forward estimate, like price to forward earnings is 42 on Netflix. They're never going to trade at that valuation if they are using a hedge of experiences, using a hedge of older consumers with cable.
Well, right. It's a much clunkier, capital-intensive business than Netflix, hence the higher PE multiple. But I'm also just talking about pure market cap.
Yeah.
You know, so the valuation the premium valuation Netflix gets is certainly deserved. But what we're saying is that Disney is really trading at a discount on all levels in the marketplace today. I mean, it's cheaper than the S&P PE when you look at forward. And then you start thinking, wait, now this business is really growing at double digits going into the fairly decent midterm. And, you know, once again, experiences is a wonderful business. Just because it grew crazily in 21 and 22 as everybody, you know, came back out post-pandemic and now it's slowed, doesn't mean it's not going to continue to gain steam as we move into 25 and 26 with new cruise ship launches, which might cost Disney on the short term as they launch the new cruise ship. But over time, these cruises are like gold mines. I mean, so Disney is a cash cow. They're returning money to shareholders. They're extremely shareholder-friendly company. And, the big question is succession planning. And once they clear that up, then, Disney has a great runway over the next, 5 years.